Okay, in today's video, we're discussing why a recession is not coming and why you should position your portfolios accordingly. Now, if a recession is coming, I would like to posture the argument to you, why does it matter? So what, a recession comes, the market is down 20% from the highs. Well, at least it was in 2022. If a recession is coming, no matter how bad that can be, you're supposed to buy prices when they're low and sell high. So I don't understand people who think a recession's coming and I need to buy after the recession ends. Well, here's one thing. The market is forward-looking 12 months. Last year, I was pounding the table in 2022, making the argument that yes, while the Fed has a few more basis points to go, they're either at 3 or 4% on their terminal rate. If the market was already forward-looking 12 months, and that is priced in. So there's a guy on CNBC today, but you see the guy in the top right picture. Okay, he is always so bearish, and he's saying that this year is going to be like last year. We're going to have the recession come because the layoffs haven't happened yet, and in order for the layoffs to come to fruition, the Fed needs to raise rates more, which they will do, and that's going to make companies have to hire less and fire people because interest rates are too high for them. So, which means they can't take loans and expand the same way they want to expand business. So they have to fire people in order to meet their bottom lines, and that's going to then hurt the economy and drive us into a recession. Okay, again, let's just say that happens. Who cares? First of all, let's just acknowledge that point. The recession comes, the market falls. How much further could it fall from the highs that it was at last year? I mean, let's just go into a chart. The S&P was off 20% from its highs. At one point, it was down almost 30% from the highs, okay? And it doesn't matter if it was happening before the recession happened. The market is always forward-looking. So in 2023, we bottomed around 380. And you might think, well, this is all going to end soon because the recession is coming. We just haven't gotten our long-awaited recession. It doesn't matter. The market's already anticipating that. The 0 to 4 interest rate hikes happened in 2022. So there's only one more percentage rate to go from 4 to 5 in 2023, and that's already been priced in. And that's what this narrow range is, as you see, as we chop sideways. That's been priced in. Another argument I don't understand people make about recession, even though things are forward-looking and even though stocks are down 20% from their highs, the indexes, the stocks are down even worse from their highs. Some stocks are down 50% from their highs, like Tesla. But they also think that some stocks can win in this environment. Like the guy I just showed you, the picture of that guy. He thinks that certain credit card companies can win and certain healthcare companies can win in 2023. But a rising tide raises all ships. So if a recession is coming and the whole market drops, then every stock will drop with it. So I don't understand the bears who think that a recession is coming, even though the market's above the 200-day moving average here and we're looking very positive, as I show you on the chart. I don't understand how they think a recession's coming, and a market crash is coming. However, some stocks are good to pick and buy in the meantime, like credit card companies or healthcare companies. I don't understand. A rising tide raises all ships and lowers all ships. So, and then one other bear argument people are making is China. You know, all the military aggression with China. It's the same argument I made with Russia and Ukraine. Look, you just buy through all those problems. You buy. Here's why. If the world is ending from Ukraine and Russia doing a nuclear, bomb someplace, or China, invading Taiwan, and then eventually we go to a nuclear war, then life as we know it is over. So it doesn't matter if life is over and you lose all your money in the stock market, because life is over. So if life is over as we know it and we're living under a new regime in China or Russia, it's not going to matter how much money we have in our bank accounts. So I think it's the ultimate bluff, the ultimate great wager to buy on geopolitical weakness, because if that really were to come to fruition, aggression against nuclear power, then life is over as we know it. So buy everything anyways. If the market goes up 7% a year on average, let me go back to the SPY chart, okay? The market goes up 7% a year on average. So And let's just look at a full-time chart, a full chart here of S&P on a max time frame. You'll see that it never goes down. You see that? It just goes up forever and ever. Yes, it has its dips, but that's when you buy things, is on these dips. Okay? I don't know how else to explain this to you. You block out the news, you buy the dips. Maybe that's not convincing enough for you. Let's do a full-time chart here so you can see it a little more clear. We'll do a 20-year chart on the S&P. And as you can see, yes, we've had a perfect dip, and now we've gotten above that yellow line, the 200-day moving average. That's when you start accumulating again. Every time we get above the 200-day moving average, it's when you go long-term bullish, okay? It's when you really start accumulating shares. We get above that yellow line, we move higher. So we're just now getting above this yellow line again from a correction. This is when you load up your shares. We're already up in the pre-market, as you can see. So if you are going to listen to all the bears, you're going to lose. You're never going to make it in life because they constantly want to hold you down in a fearful position when you should be using these low prices to accumulate. The market's going to go up over time. Didn't you see the chart I just showed you? So you buy the dip. Now is the dip. And if we dip further, guess what? We make $97,000 per year. So all we care about are our dividends. Last year, our dividends paid back our losses in the market. And today, in 2023, our dividends are doing the same thing. We have 200 grand in margin, and the 100 grand that we earn in dividends will knock that 200 grand margin down by the end of the year. And it doesn't matter if the market goes up or down. So whether people are calling for a recession, and brace yourselves and stay out of the market and go get some treasury bills for 4 or 5% interest, that's nothing compared to what the market can do in a day. The market can go up 2 or 3% in one day. We're up 30% for the year. Well, we're up 27. Last video you saw, we're up 30%. So I don't understand the bearish arguments of a recession. The market's always forward-looking. So we priced that in last year, 0 to 4 interest rate points. We priced that in last year, and we looked ahead to 2023 with only 1% more to go in rate hikes. The market's forward-looking. You can see it on a chart. It's balancing out on a chart. We're getting above that 200-day moving average, that yellow line, which I've been making tons of videos about. This is the time that you go multi-generational bullish. And even if you're wrong, the dividends pay back the losses. Thank you.